we're going to talk about the primary and secondary market. So on the agenda for today, we're first going to have our weekly news report. Then we're going to dive into primary and secondary markets. And lastly, we're going to have an investing analysis activity. So first piece of news is the Israeli Defense Minister Yoav Gallant was fired. So last year, the Israeli Prime Minister attempted to fire Gallant after criticizing the Prime Minister's plans for a controversial judicial overhaul before the Prime Minister backed down in the face of street protests. And more recently, due to the Israel-Gaza war, they've been fighting about how Gaza should be ruled once the war with Hamas is over, with Gallant often criticizing the Prime Minister. So therefore, the Prime Minister, Benjamin Netanyahu, fired the Defense Minister because they had significant gaps in the relationship during the wartime.
Okay, the next headline is from FT. So Apple warns investors future products may never be as profitable as the iPhone. So Apple has warned their investors that their future products may not be as profitable as their current offerings, particularly referencing AI and virtual reality headsets. And analysts have suggested that AI and VR products have lower profit margins compared to Apple's very successful smartphone and app store. And finally, this cautionary statement from Apple indicates potential challenges in maintaining its historically very high profit margin. So it'll affect Apple's market cap and share price.
I was wondering, like, why Apple won? Just because I feel like it's gonna be disadvantage for like Apple to like a lot of money from investors.
Yeah, definitely. I mean, I think that it's definitely part of their strategic move, and they don't share our strategies with us, but the iPhone is really was the boom of Apple, right? Like when Steve Jobs gave that speech and he showed the iPhone, it like skyrocketed the share price, and it's what has made Apple like $1 trillion company today, right? And I think that AI, VR, so much funding has gone into like hundreds of billions of dollars. And I think that it's a buzzword, honestly. Like people are overestimating the returns that AI has on the tech industry. So I honestly think it's good of Apple to report that.
I think one of the main things is having transparency with your investors, because the whole point is you want to build trust in your relationship so that they can believe in you in the future. Yeah.
And then finally, we all know election night is tonight. So we're not going to go too deep into it, but Donald Trump and Kamala Harris have spent $3.5 billion in the most expensive presidential election. Now, not only is this the most expensive presidential election, but it is the closest election in all of US history. No election in US history has been this close between the top two candidates. So it'll be really one interesting one to watch tonight. So again, together $3.5 billion for the 2024 presidential campaign. Harris raised $2.3 billion and spent $1.9 billion, while Trump actually raised less. So he raised $1.8 billion and spent $1.6 billion.
Yeah. Okay. So now we're gonna, oh, yeah.
Do the pressure of elections just grow exponentially? Like, is that expected that it's that much more effective than previous elections? Or is that kind of like unexpected?
I think that given the magnitude of like how close these two candidates are, first of all, and the fact that Biden just completely dropped out and people were like, we need to funnel money into Kamala as quickly as possible because she's late into the game, right? I think that was a large effect. So yeah, good question.
Great. Now we're going to dive into primary and secondary markets. So at its core, the primary and secondary market are both financial platforms. And what a financial platform is where buyers and sellers trade securities like stocks and different types of debt. So what financial platforms provide for us is liquidity, which is turning your assets into like money. they provide participation in the economic circle, and they provide capital for business growth. So these are essential for economic growth, which would be increase in the amount of goods and services that are in demand, and stability, which means low and stable inflation rates. So the financial platforms are essential for trade and commerce as well as growth opportunities. And if we didn't have financial platforms, the world as we know it would cease to exist.
Okay, so there are two parts of what we're going to be talking about today. The first is a primary market, the second is a secondary market. We'll start with the primary market. So at its core, the primary market consists of two parts. First, let's have a flashback to the first meeting. Alyssa, the founder of Lumino Technologies, they need money to grow, to fund their R&D, their research and development, to fund their factories, to fund their delivery. And so the other group we have is investors. So this can include what we call hedge funds, banks, mutual funds. We'll get into all of that. And they want ownership of Alyssa's company because they believe that it will be very successful and that it will grow. So how it works is Alyssa raises capital for Lumino by selling ownership of her company to these investors. And in return, investors gain a portion of ownership of Alyssa's company. What that means is if Alyssa's company, they purchase like 10 shares of Alyssa's company and the price per share is $10, but then over time, the price per share increases to $20, then when they sell those 10 shares, they'll make a profit based on the increase of the share price. So there are a couple forms of primary market investments. The first is what we call IPO, or initial public offering. And this is when a private company goes public. And what that means is when a company is no longer funded by venture capitalists or angel investors, and it's listed on a stock exchange, and it can be sold to anyone around the world. And that is when, for example, I would buy portions of Alyssa's company as it goes public. And then the other is bonds. So this is a type of loan from investors to a business or government with periodic interest and promise of return. And for example, if Alyssa has a $5 million project, I can give her $5 million and she'll pay me a portion of those $5 million for giving her that money over a period of time.
And then we'll move on to the secondary market, which is what most of you know as the stock market. So what the secondary market is, it's where individual investors and various types of funds who already own parts of a company, such as Lumino, and they want to sell. And they're in contact with individual investors and various types of funds who want ownership of this company. And they trade stocks between each other so that they trade already issued stocks between the investors. Yeah.
Who buys those stocks or bonds in the IPO versus the secondary company?
Okay. Investors, yeah. But the difference is the investors who bought the stock in the primary market now move into the secondary market to trade with other people when they want to sell.
So who's like the primary?
So basically, when a company is not listed on a stock exchange consists of only public companies. When a company is private and it initially jumps from the private world to the public world, that transfer results in the primary market because it's that initial jump from I'm a private company to I'm a public company. And that's when investors buy directly from that company, shares directly from that company. Whereas in the secondary market, that company is already public, right? So it's investors who already own and they're selling to other investors. Yeah. Does that make sense?
Yeah, but usually for like the specific investors, it should usually be people that the company already knows throughout their journey, and they'll reach out to them and say, "Hey, I'm selling parts of my equity right now. Do you want it?" And it's much more of a direct transaction rather than like for example, individual investors a lot of the times are retail investors, like people like you and I, who just trade stocks because we want like a small income. Okay, so we've explained primary and secondary markets. Who can tell me the difference between primary and secondary markets? Yeah.
The primary market is where just public to private. So the investors, usually the company does that, and they're just taking directly from the company. And the secondary one is where it's just trading between investors and it's already existing company.
That's exactly right. Perfect.
Okay. So now we'll move on to the history of primary and secondary markets. So early forms of the primary market originate back to ancient times when the Egyptians would build government structures such as the pyramids, and the pharaohs would loan money to the organizations that wanted to build these pyramids. And it was the exact same thing for times of war in the Roman period, where people such as Alexander the Great, who were emperors of the Roman Empire, would lend money to war efforts, expecting a return.
And that's really interesting to me because it's essentially the circulation of money. Like you can imagine in some cultures, like the top elite people would like live in these castles and they just store all their money in like the dungeon or something. And it just sits there stagnant. Like the money would just be part of the elites and it would literally sit there and nothing would happen. Whereas here, money is actually being invested into projects and growth and innovation. And that's why we see so much technological innovation today. It's built on these fundamental things that Alyssa just explained.
Yeah. So obviously this is before like organizations and like investment companies came about. So it was more directly from the government to people they're governing instead of between like a company and investor. And then the early forms of the secondary market originates as early as in the 1600s, where the Amsterdam Stock Exchange was established. And also the London Stock Exchange was established in 1698. And it is now one of the largest stock exchanges in Europe, which we'll talk about later. But the point is that these concepts are not new, but we just keep on innovating and making them even more accessible, such as going from traditional stock exchanges, which is physical locations where people trade stocks, to electronic stock exchanges where people can now buy stocks online. Does that make sense? Okay. So now we're going to talk about the stock market.
Okay, so there are many stock exchanges all over the world. A stock exchange is basically a way for companies to list their company on the exchange and investors to go in and purchase ownership or sell ownership of those public companies. But we're going to cover four main stock exchanges. The first one is the New York Stock Exchange, which is the largest stock exchange in the world by market cap. And market cap just essentially means how much money is circulated within that stock exchange. So the New York Stock Exchange has a market cap of $55.2 trillion. If you think about it, the GDP of the US is, I think, $24 trillion. So it's more than the GDP of the US, almost double, more than double. And then we have the London Stock Exchange, which is Europe's largest stock exchange. We have the NASDAQ, which is primarily known for tech stocks, and it's the second largest stock exchange in the world. And then bottom right, we have Japan Exchange Group, which is the largest exchange in Japan.
So there are different players in the stock market. Obviously, first, we have the individual investor, who is a non-professional who trades and sells for their personal portfolio in very small quantities. Most people usually do rely on stocks as a smaller source of income, as I mentioned before. And then we have mutual funds. So what mutual funds are is when multiple investors come together to create a pool of money, where that money is then invested into a diversified portfolio by professional fund managers. Okay.
And what's really interesting about mutual funds is they get their funding from institutions, but they can also get their funding by individual investors. For example, if you're like, instead of investing my own money into different stocks, I'd rather give my money to a mutual fund that has professional investors, all types of advanced researching tools. I would probably trust the mutual fund more than myself. And so that's,
And then we have ETFs, which are a type of security that you can invest in. So an ETF it just stands for
exchange traded fund.
exchange traded fund. And what it is, it's a collection of different instruments that can be bought and sold on exchange like an individual stock. So an example of an ETF would be SPY.
Which is the SPY 500. We can get,
Yeah.
we'll get more.
We'll get more into that later. And QQQ, which these are the two big ETFs, but right now you don't need to worry about them. Just know what an ETF is. What?
For mutual funds, when you give your money to them, do they take
Yeah, so I think that they usually take a cut of like they take interest or like a cut of the profits that they make, if that makes sense.
Yeah.
One thing to note about ETFs is that at a very basic level, they track different bundles of companies in the stock exchange. And what's really interesting is that the returns on ETFs have actually outperformed the returns on mutual funds very consistently. So a lot of people are like, why would I give my money to professional investment firms when I can literally just invest in an ETF and it performs better than all of these mutual funds?
Usually ETFs track the top 500 or the top 100 companies on an individual stock exchange. So they do have a higher chance of performing, but
yeah, they have a higher chance of performing, but we still need mutual funds because we do need investment firms to invest in people who are more than just the top 500 companies. Because then how are we going to see growth? How are we going to see diversified competition?
And then more players is institutional investors, which we've talked about, which are usually pension funds, insurance companies that invest in significant amounts in different companies. And we also see hedge funds, which are private investment funds that use advanced strategies to earn high returns.
And hedge funds are a really risky form of investment.
Yeah.
You have a lot of failures, but you have really big wins. And if you have just like one or two big wins, it could be like, Okay.
Okay. So now we're going to talk about stock market booms. So stock market booms are usually associated with a bullish attitude. And bullish attitude is when the investors believe in the stock market. They believe that it's going to rise and there will be positive results. So stock market booms are when the stock price rises significantly due to positive economic factors, investor confidence, and strong corporate earnings. Whereas in contrast, we have stock market crashes, which is characterized as bearish. And bearish just means low investor confidence. A stock market crash is a sharp decline in stock prices due to factors like economic downturns, like geopolitical instability, and financial crises.
Yeah, and you'll typically hear like when you're
Is there a specific reason why it's important?
I don't know the history behind that, but good question. I don't know. We'll have to look that up, but it's a good question, Hannah. When you're reading like the Financial Times, for example, or The Economist, you'll hear like the investors are currently bullish on the market, which means that they think it's going to go up and that company share prices are going to increase, or they can be bearish on the market, so they think that there's declines in the stock market, companies are losing their value, etc. Okay, and then before we do our final activity, we're going to discuss the 2008 financial crisis. I think the best way to explain it is just a video because it's quite complex, but
Main message is that these lenders were selling high risk loans to people with poor credit histories because they expected the housing prices to increase. And this is because they had a bullish attitude towards the housing market. But when housing prices did not increase and people who had the poor credit scores weren't able to pay back their loans, everything crashed and led to one of the biggest economic recessions of American history. Of course, we bounce back from it because at the end of the day, everything is a cycle of inflation and deflation. But I think they raised interest rates in order.
I don't know exactly the details of like post 2008. That's a good question. I would say that, like, did you hear the Dodd-Frank Act? The Dodd-Frank Act, that helps with more transparency before you give someone a mortgage. So like policy is definitely like so closely interrelated to investments because it helps like protect people from just not taking a mortgage and then not being able to pay it back, right? So I think policy is probably one of the biggest interferences.
But yeah, we definitely bounced back. The US economy was going strong until COVID, but now we're going strong. So it's fine.
In the world.
Okay.
That video was stressful.
That was a very stressful video. Sorry, but this is just a good piece of information to know because so many people still mention the 2008 financial crisis to this day.
Yeah.
So just have a baseline understanding. Okay, now for the last activity, we are going to have investment analysis. So first, we need to teach you the basics of investing. So what we want you to do is take a top-down approach. The first thing of a top-down approach is to examine market trends. So you're looking for specific sectors and what sector is in the most demand right now. What sector is growing? For example, since a lot of people, we are in wartime because of the Israel-Gaza war and Ukraine-Russia war, people are preparing for military defense. So a lot of people have been investing into military companies that can help protect the US security. That's an
Security
example.
companies are so big right
Okay. Oh.
now. Wrong order, it's okay.
Okay. The next one is understanding the business so that once you identify the sector that you want to invest in, you want to look at the sector leaders. So what you want to do is you want to look into individual companies and see what the company offers that is currently in demand. For example, with Sophia's lithium company, because I needed a good lithium producer, Sophia's company was in high demand for me personally. And lastly, check the price. So before investing into stock, you want to look at its price to earnings ratio, which is essentially a price tag for stock. The price to earnings ratio is how much investors are willing to pay for $1 of the company's earning. And market cap, as we mentioned before when we talked about the New York Stock Exchange, it's just the number of shares in the company multiplied by the current stock price, and that gives you the total amount of money circulating for this company. And a key component of this is you don't not only look at the company's individual PDE ratio or market cap, but you want to compare it to other companies and other competitors in the same sector.
That's what I was about to say. Thank you, Alyssa. And then also just zooming out a bit, this is an approach we're going to have you do, very basic, but if you're looking at mutual funds again, their whole goal is to figure out how is my approach, the approach that I design to picking the companies that I invest in, how do I make that better than other mutual funds to outperform them? So there's a whole market of investment firms that are just figuring out what will my approach be, what data and analytics will I use so that I can have higher profit and returns than all the other investment firms out there.
Yeah. And this is the top-down approach, and this usually prioritizes long-term growth potential, but there also is bottom-up approach where you look at an individual company and analyze a stock based off that. But I know price to earnings ratio and market cap are pretty new concepts, but the gist of a price to earnings ratio is it's a value of the company's stock, right? So usually the price to earnings ratio will tell you whether the company is undervalued, which means it may have some room to grow, or if it's overvalued, so many investors are already investing in this, it's going downhill. But that's a very one-dimensional analysis of it, and you need to really look at the market cap as well to see what the size of the company you're dealing with. So for market caps, companies with over 10 billion in their market cap are large companies, which might not have as much growth potential, but they're steady. Whereas smaller companies, such as anything below $2 billion in market cap, are smaller companies with higher growth potential, but they're more risky, and you really need to analyze your stocks well. Okay, so the 3 stocks that we want you to do is NVIDIA, Boeing, and NewScale. And these are all companies in different sectors. So we are going to split you by group.
Okay. Oh, and also the main questions you want to answer is, first of all, basic understanding of the company. What do they do? Then, what is their current price to earning ratio and their market cap? And then finally, where is the demand? What does this look like in the broader industry? And would you buy? So, okay, guys. So we can just do a share out for every company. Let's start with NVIDIA. Who did NVIDIA? Okay. We can start here and then just go around.
So in the past, basically, we sell a lot of like GPUs and also chips for like gaming systems, and their main market is AI.
And, their ratio is 55.5.
For guys, just to the fact that last year was, valued around the trillion. So I think it's and the demand is increasing.
Okay. And do you see growth potential? Would you buy it?
We definitely see growth potential because like they're focusing more and more on AI right now, which is a very popular field. So like we think it would be a good idea to buy the stock.
Okay.
We also try to like invest in semiconductors and things like that. We feel like that semiconductors are really important for the US, like Amazon. In general, like you said, like AI is like some of it is so like a lot of people are it's like a lot of the factories that are like still there's nothing telling them to not invest in it right now. Like over the last year, there's been like very like we haven't seen any reason for it to drop yet. Even in like the last month, a lot of like maybe not a lot of just like AI. That's good thing.
Okay, nice. So you'd buy it. Okay.
Yeah, there's not, it's really hard to just it's full game. But no, there's not much risk either way in return, so it's steady.
Yeah, but we looked at some of this because and videos is a lot higher, so getting that.
So you think NVIDIA's PD ratio being higher is good? You think it's bad? So you wouldn't invest?
Because it's like overvalued, and they also said because like as now just surpassed Apple as to be like one of like the highest like stock. I don't really know exactly what it is, but basically it's as Apple like the basically stock exchange for like AI companies. And as of now, it kind of already had its golden age, so it either is going to stay consistent or maybe up.
Yeah, I think that's a really good insight. But all of you guys did great. Okay, now moving on to Boeing.
Okay, so, Boeing is, a plane, like, it's an American, company in like the plane sector, so it designs, manufactures and sells airplanes to different countries, like, it's like a very big company, very internationally renowned.
Its current duration is -12, which is really bad because like the one is between 28 and 25.
Yeah, and so the market cap right now is, 112.82 billion, which is very big. I mean, it's pretty big because it's a very big company. So like, there's obviously like a significant demand because of everything that it does. So like in design and manufacturing, and right now there's significant strikes around going. Like, yeah, lots of mechanics are striking, and because of that, like, it's a big issue for the country because it's got too much demand and so many people relying on it, and since no one's really like showing up, because they're on strike, their customers really there, and that's why, there's like the strong market in that particular sector of manufacturing. And so, yeah, we would not buy from there just because of the like strikes happening right now, it would just not be able to.
Good job, guys.
Also, I think that at this point, Bowen's reputation is like kind of known to be like unreliable and trustworthy.
Yeah.
And the second I hear Bowen, I kind of just think of like airplane problems. So I feel like it had its like golden era, or I don't know what you call it, like its moment, and it's just.
Based on what I saw, the E ratio was -33, so that's like 94 was already pretty bad.
Did you research like how PE ratio could be negative?
They're losing money.
Uh,
Yeah, so like if you're losing money for every dollar of your share, then that would be negative. So they're losing a bunch of money.
There's been money.
Oh, yeah, so we also found out that it had a 6.2 billion loss in the third quarter of 2024. And it has kind of a weak cash flow, even though the worker strike is like ending, it still seems to be on a negative track.
Yeah.
So. And we've also found that the demand in Southeast Asia, China, Eurasia, and Latin.
That's very fitting. I think Boeing CEO also stepped down. Like there have been major changes in its leadership too, so it's not
Pray for
fair.
Boeing. Okay, what about new scale?
Okay, were you the only group that did new scale? Oh, and you, okay.
So the company does small molecular reactors that are used in underground pools. And its credit price to earning ratio is also negative, so it's -25.8, which is worse than in 2022 when it was -20.5. And this is because the Federal Energy Regulatory Commission denied a request on November 1st that would allow the electric power utility to increase the amount of power of its nuclear plant and Pennsylvania, which also decreased Amazon shares, and it has a $450 billion market cap. And the demand for this product is due to the growing need for reliable and carbon-free base load, and because of the negative price point ratio, we do not buy it. Because it's not good.
Yeah, those are some vision, we will buy it, like, I always do a way to see like how it goes, because, if you're looking at pricing street, like stock pricing street, and then really, it's gonna peak it now. But because of that, like, you can see that there's a huge demand in this company, but because it's peaking, meaning that like there's, like a bigger risk of like losing value in the future, so in the long run, like we can't like estimate like how it goes, so. Yeah.
Okay, perfect. Thank you so much. That was lovely, guys. Okay, that's all for today. We're meeting one more time next week. Thank you all so much, and we hope you have a great rest of your penultimate week.